Something really strange is happening in the silver market, and I need to show you what's going on. It looks like silver miners are being deliberately held down, even while the price of silver itself is soaring. Tomorrow, January 16th, could be a critical day, and I want to explain why, what I'm watching for, and how I'm planning to navigate it. Let's start with this morning, January 15th. Silver dropped a sharp 4%. Now, you'd expect silver miners to get crushed, right? But here's the weird part. The main silver miners ETF, which we'll call SIL, only opened down about 1.4%, and then it quickly bounced back. This shows incredible relative strength. The miners are refusing to go down with the metal. So why is this happening? It's all about the massive short positions held by the big banks, timed perfectly for the monthly options expiration, or OPEX, which is tomorrow. They are fighting tooth and nail to keep a lid on this market. This brings us to what I call a huge structural anomaly. Right now, silver is trading around $91 an ounce. It's been a fantastic run. But if you look at the stock prices of the companies that actually dig this stuff out of the ground, they're trading as if silver were still at $30. This disconnect is massive. The miners are valued at a fraction of where they should be, based on the current price of the commodity they produce. It simply doesn't make any sense from a fundamental perspective, and anomalies like this don't last forever. To understand why this is such a big deal, you need to grasp the concept of operating leverage. Think of it this way. A silver mining company has certain fixed costs to run its operations, paying workers, running machinery, things like that. Let's say their all-in sustaining cost, or AISC, is about $30 to produce 1 ounce of silver. Now, if the price of silver is $35, their profit margin is $5 an ounce, or about 14%. It's decent, but not spectacular. But what happens when the price of silver skyrockets to $91 like it has now? Their costs are still around $30 an ounce. Suddenly, their profit on that same ounce of silver jumps from $5 to a whopping $61. Their profit margin explodes from 14% to 67%. This is the power of operating leverage. Their earnings are spring-loaded. For every dollar that silver goes up, their profits don't just go up by $1, they multiply. This is why these mining stocks should be flying high, but they aren't. Not yet. Of course, the skeptics have their arguments, so let's address them head on. First, they say costs are rising. And yes, all-in sustaining costs have gone up with inflation. No one denies that. But the price of silver has risen much, much faster. So even with higher costs, their profit margins are expanding dramatically. This argument just doesn't hold water when you look at the raw numbers. The margin expansion is real, and it's happening right now. The second argument is jurisdictional risk. Some of these mines are in countries with unstable politics, and governments might try to slap on new taxes to get a piece of these windfall profits. This is a valid concern. However, this risk is already well known, and it's a big reason why these stocks are so cheap in the first place. The market has already priced it in. The opportunity here is to capitalize on the violent catch-up rally that happens before new tax laws can even be drafted and passed. The market will reprice these companies based on today's profits, not some hypothetical future tax. Another point people bring up is declining ore grades. This means miners have to process more rock to get the same amount of silver. This is a real long-term trend in the industry. But it's a slow-moving geological reality. It absolutely does not explain the sudden, short-term valuation gap that has opened up in the last few months. It's a convenient excuse, but it doesn't fit the facts on the ground today. Finally, there's the big one, bank manipulation. Many people believe the paper silver market is a rigged game, and honestly, there's a lot of historical evidence to support that. But here's the thing, even rigged games can break. When the price in the paper market gets so disconnected from the physical reality of supply and demand, something has to give. The elastic band can only stretch so far before it snaps. I believe we are approaching that snapping point. So all eyes are on tomorrow, January 16th, for the options expiration. We're going to see a massive fight, especially around the $90 and $95 strike prices. There are billions of dollars in notional value on the line. The banks who are short will do everything in their power to keep the price below those levels. I expect to see a ton of volatility. Don't be surprised if you see some very creative interventions to suppress the price during the trading day. It's going to be a battle royale. And where is the mainstream financial media in all of this? Crickets. They are completely silent. You won't see this story on the major news networks. And that's a good thing for us. This media blackout is allowing the smart money, the investors who do their own homework, to quietly build up their positions in these undervalued miners before the rest of the world catches on. When the story finally does break, the easy money will have already been made. So, what's my personal battle plan for this? Today, if silver finishes the day in the red, but the miners ETF, SIL, manages to finish flat or even green, that's an incredibly bullish signal for me. It confirms that underlying strength. In that scenario, I'll be looking to add to my positions in the miners. The key level I'm watching for silver itself is $91.50. If we can hold that, it's very positive. However, if the OPEC's chaos tomorrow sends silver tumbling below $85, I'll just sit on my hands and wait. You have to be disciplined and not try to catch a falling knife. My primary target is for this inevitable catch-up rally, to push the mining ETF back to its highs from 2025. If we look at history, this pattern isn't new. In past bull markets, the miners almost always lag the metal at first. They get ignored, they get beaten down, and investor sentiment is terrible, but then, at a certain point, the market wakes up to the incredible value. And when it does, the miners don't just rally, they explode higher in violent, fast catch-up moves. We saw this exact pattern play out back in 2010 and 2011. I believe we're in the exact same spot today. The tension is coiled so tightly in these stocks. Based on my calculations, the miners are mathematically undervalued by a factor of at least 3, just to reach what I would consider fair value relative to a $91 silver price. And that's not even accounting for the speculative frenzy that could kick in once they start moving. The potential here is enormous. This is a rare and incredible opportunity, but it's not for the faint of heart. The volatility will be intense, and the powers that be will not give up easily. But the fundamentals are undeniable. The math is simple. The miners are too cheap, and a repricing is coming. The only question is when. Keep your eyes on the market tomorrow. It's going to be an interesting day. Thanks for watching, and be sure to subscribe for more updates as this story unfolds.